All right. Today is Wednesday, August 16. This is a recap for the stock market activities today. Now, folks, I got a good one for you tonight. And boy, do we have interesting moves in the market or what. But understand that every major move in the stock market, be it a bubble rally, just like we saw recently, or even in correction or bear market rebounds, the move is usually concluded by what we call a climactic ending, also known as climax. And we can identify climax because it comes with a huge move in volatility, either a massive explosion in the VIX or a massive dump in the VIX. And we know it's climax because it comes with huge positioning in options. In the case of rallies, when we conclude these rallies, you see calls reaching the high 60s, the 70s versus puts. In the case of sell-offs, we see puts increasing to the 60s and 70s versus calls. Likewise, we can identify a climatic move because we look at the charts, we look at the indicators such as the RSI, and we see huge overbought or oversold readings. These are some of the identifications that we have to look for when we look for a climatic ending. When this corrective phase began, we were anticipating a garden variety correction, which is 8 to 10%, sometimes 5 to 10, it goes as high as 15. But the range goes from 5 to 15%. And then we see what happens. But the problem with the climatic ending is the fact that it is the most dangerous phase in any rally or any correction. In climax, things get shaky and heated, and we could see sudden explosions. And usually the results of these explosions have dire consequences, sometimes for decades to come. I mean, look at what happened in the top of the dot-com bubble, for example. That was a climatic ending. And in this case, in the correction that we have right now, we have plenty of evidence, and I'm going to show you in the charts and the options, that we're getting really close to this climatic ending, which is a massive flush down. Things get really oversold, the VIX explodes higher, and then we perhaps rebound midday and we find a tradable bottom. However, during the climatic ending, if we step on a landmine, for example, be it from a fundamental catalyst, a technical catalyst, or even a mechanical catalyst such as OPEX, then the climax could end in a massive explosion and a crash. And this is why I would say, ladies and gentlemen, buckle up your seatbelts. Things are about to get really, really interesting. But let's talk about some macro before we talk about the market. And here's the headline for you. It reads, Rich Dad, Poor Dad, author Robert Kiyosaki. Big fan of the show, by the way. The guy wrote a book that sold 100 million copies, and he's watching some jerk-off doing a financial show from his garage. What is your excuse? Oh, Maverick, the show is too long. Get the hell out of here. And by the way, we got a lot of fans. Lawyers, doctors, hedge fund managers, even celebrities. I met one of them recently in a dispensary of all places. And I asked the guy for a selfie. Then he started asking me questions. Who are you? What do you do? And I'm like, yeah, I'm Joe Blow. I'm in finance. But he keeps pushing and pushing. Oh, but your voice sounds familiar. Then I finally capitulated and said I run a channel called The Maverick of Wall Street. But what do you know? The guy turns out to be a fan. And now he's asking me for selfies. But anyhow, the headline reads, Rich Dad, Poor Dad, author Robert Kiyosaki slams Janet Yellen for trumping Bidenomics. And he says, what is she smoking? ? And for reference, just so you know, Janet Yellen on July 9th said that recession is not completely off the table, okay? Then fast forward, just a few days later, Janet Yellen comes out and says that she does not see a recession in the U.S. A few days later, she doubles down and she says, the U.S. economy is on track for stable growth, and that thanks to the Inflation Reduction Act boost. And I say, what the hell is she smoking indeed? Inflation Reduction Act? What are you talking about? And then, of course, recently, Janet Yellen is now in a propaganda tour, starting from Vegas of all places, to sell Bidenomics. So in a few days, Janet Yellen went from, oh, recession is not completely off the table, to, hey, we're in expansion now, it's over. Bidenomics, baby. By the way, she's having a hard time selling tickets in Vegas. So if you happen to be in town, it's called the Janet Yellen Freak Show, aka Bidenomics. It's in the MGM Grand, I believe. It's a magic show. And speaking of magic, to answer Robert's question, what the hell is she smoking? Well, we now know that Janet Yellen is smoking magic mushrooms in China. Not only that, she's enjoying the hallucinogenic mushrooms. No wonder why she sees up is down is up, east is west, depression is expansion. Bidenomics works. Maybe we're going to believe in Bidenomics if the government gives us free LSD. Here's a tax refund and a little gift in there. Forget about the Las Vegas tour by Janet Yellen. But folks, we have a mass campaign to brainwash the public that what you see in real life is you're just imagining that. Maybe you're magic mushrooms, dear the American people. You're going out there complaining about the prices of gas and groceries and utilities, but in real life, everything is fine. Bloomberg says the economic and political genius of Jay Powell. I say the guy should be in handcuffs for what he's done. But now we're celebrating Jay Powell as the economic and political genius for wrecking the country's finances, for creating the worst inflation episode since the 1970s in this country. But Jay Powell's legacy is not over. In his resume, he's about to add the greatest crash since the Great Depression. And that's the economic and political genius? Give me a break. But it's full on, folks. It's all over the media right now. The Associated Press says Bidenomics delivered a once-in-a-generation investment. It shows the pros and cons of policymaking. Again, what the hell are you people smoking here? Once-in-a-generation investment? In what? In our country's debt? That's now at $30 billion? And by the way, how about that infrastructure in Maui? And again, the media says Wall Street is getting more bullish in stocks as soft landing, quote-unquote, chatter intensifies. They're talking about the soft landing and dancing all over the place while the Titanic is sinking. When we talk about a booming economy, maybe we should talk about housing affordability for a little bit, because the headline reads, middle-class Americans are moving straight into fire and drought because they cannot afford to live in cities that are safer from climate change. So they're moving to Vegas, Phoenix, really hot, dry, no water. The reason is it's almost impossible to afford living in California or an East Coast or anywhere. The headline reads, more Americans are ending up homeless at a record rate. So again, what the hell is Janet Yellen smoking? Understand that we have an entire generation of investors and just human beings in general who've never really seen bad times in this country. If you happen to be in your 20s or maybe early 30s, if you lost a job before, you got another one. The economy was booming, quantitative easing, money all over the place. You switch from a tech job to tech job to tech job. You get paid $200K, $300K. Everything's good. So we have no fear of the worst. There's a whole generation that is not prepared for anything, and they think that they got the job in the bag. So they got no savings. They spend, and it's a nation of renters right now. This entire generation doesn't own homes. They rent. They have car payments they can't really afford, lifestyles they can't really afford without the inflation wages. What happens when somebody in this situation loses their jobs? And I say jobs as plural because a lot of them are working multiple jobs. If you don't have savings, if you don't have a cushion to fall on, now you got your credit card debt, you got your student loan debt that you have to pay, you have a rent that you cannot really afford, you got a car payment you cannot really afford, but most importantly, your home. You got no home. What happens if you cannot afford rent? Because it's going to take a lot of time to find a job, let alone at the same rate of wages. There is a thin line, ladies and gentlemen, here between you living in dignified conditions, in a home, in an apartment, and between you ending in the street corner. So is this really the booming economy, Mrs. Yellen? Is this really Bidenomics? What's going on here? There is no safety net in the most basic thing, which is housing. We continue to get bad news, folks. I mean, I don't know if you saw the action in J.B. Hunt, for example, today, down about 3% or so. And they said bad things about the trucking industry, which is a leading indicator for the economy. I see this as worrisome. How could we have a booming economy when we have perhaps the most important and vital sector of the economy being sick? Today we got earnings from Target, even retailers. I mean, it was a horrific report. By all means, the stock rallied based on empathy, a relief rally. It wasn't the worst. But you look at the report, it's absolutely horrific. And they continue to say that, look, this organized crime problem of theft all over the place, it's costing us a lot of money, billions of dollars. And all of these investment in security, that's going to be passed on to the consumer. And the consumer is getting weaker. They're not spending as much as they used to before, at least not on necessities. So you got stores like Target now facing a lot of financial stress. At some point, if business slows down dramatically, they're going to have to close stores. They're going to have to get rid of employees. Again, is this really the booming economy? What are you smoking? And of course, we got the GDP estimate by the Atlanta Fed. Maybe the Atlanta Fed is smoking something good over there because they say that the GDP is going to be over 5%. And Jim Bianco says, and if there is a boom, where would we see it? Question mark. And this is in reaction to the GDP. He says the Cleveland Fed just increased, are you paying attention or not? Increased their August CPI to 0.79%. This would take the year-on-year CPI to 3.82% at a minimum. You really think that the market will handle a CPI rebound to almost 4%? You think Jackson Hole Mr. Payne is not going to come back? You think the Fed is not going to increase rates in September? Think about what you think about.
Think about what you'd think about.
Then Jim says, so is this boom bullish, quote unquote? If you're long inflation, yes. If you're long oil, yes. It's not over, folks. And the bond market says that clearly. Furthermore, the disaster in Maui, the losses are in the billions now. All of these insurance companies are on the hook right now. What are they going to do to counter the cost they're about to endure right now? The answer is raising rates on the rest of us. You and me, baby. We're going to pay more for home insurance, for auto insurance. No wonder why the stock of Progressive shot up significantly higher today. More and more and more. That's inflation, folks. And the worst case scenario is, if you have inflation but you got growth, okay, so far so good. But the moment growth stops and inflation sticks, you got stagflation, and that is a major problem. Even BlackRock, even the criminals of BlackRock, are now expecting the economy to flatline for a year. Listen to this, before inflation returns in 2024. Get ready for a generational shift to full employment stagnation. That's from BlackRock, folks. The CEO of BlackRock dumping stock. You think that's a coincidence? Think again. Our base case is that the economy broadly flatlines for another year as the full impact of higher interest rates comes through and consumers exhaust their pandemic savings. A stagnant economy is slightly better than a shrinking one, but the BlackRock analysts, they say that if their prediction is correct, the economy will have essentially flatlined for 2.5 straight years. And listen to this, that would be the weakest such period in a post-war era outside the global financial crisis. BlackRock analysts also add there is a big structural shift underway that could cause problems for the U.S. in the long term. What are they talking about? Here it is. Changing demographics and a rise in early retirements are increasing the share of retirees in the U.S. population. That could lead to labor force shortages, which will slow the economy and have the potential to reignite inflation. Our assessment is that we are set for a full employment stagnation, arguing that as labor shortages start to bind in 24, inflation will go on a roller coaster ride and re-emerge. Rising wages are great for workers, but with increased pay comes less profits and increased costs for businesses, and that could hold back business investment and stoke inflation. And on top of that, a smaller workforce means that the rate of growth in the economy will be able to sustain without resurgent inflation will be lower, more like 1% than 2% we were used to. Well, I don't know about you, but this doesn't sound good at all. I disagree. I think it's going to be a lot worse. I think the Fed will raise rates higher and higher because inflation is sticking right now, and it will rebound as soon as possible. And in raising rates higher and higher and higher, in combination with the Treasury Department issuing the deluge and the Bank of Japan policy, we could see rates exploding higher, and we hit a systemic risk event that forces the Fed to cut rates. But the inflation dilemma is not over, and we're left in a world of a recession combined with higher inflation, and we have a huge, prolonged period of stagflation. And again, is that really a booming economy or is it a kabooming economy? Anyhow, folks, let's talk about the market because we got some interesting action. And if you're paying attention in the morning, you aced the action today. Here's the morning brief. It says, good morning. Since trading is led by algos in recent days, we have to continue to watch the dollar and yields. When it comes to the Dixie, the dollar index, what I see in the 30 minutes chart, and this is before the open, by the way, is an inverse head and shoulder pattern, indicating that the dollar is heading higher. We have the previous high of 103.27 as resistance. If broken and the Dixie proceeds to challenge the next high at 103.458, then the market will sell off. On the other hand, if the Dixie fails to pass the first resistance at 103.27, then the market will be able to rebound. Now look at what happened here. These are the charts that I gave you in the morning. I said, look, if we have a retest to 103.27 and it fails and we go down to 103.081, then the market will rebound. But if we go to the resistance and we pass, if it is broken, then the equities market will start to sell. Well, guess what happened today? Here it is, the update. We went down. Look at this. We went down in the morning initially. As we hit 103.27 in the Dixie, we went down in a retest to 103.081. And initially in the morning, the Qs, the SPY, were popping higher. And then, of course, when the Dixie bottomed, it caught that support, forming a higher low, maintaining the inverse head and shoulder formation. The moment it began moving higher at around 7:30 Pacific time, look at what happened here. We look at the Q's 5 minutes chart. We opened gapping lower, and then the dip was bought, and we saw a rebound. But around 7:30, we saw the top in the Q's, and it started to reverse down from that point on. Another trick, another trap. But we're not going to fall for it, folks. And then I gave you an update before the close. I said per morning brief, if the Dixie maintains support and goes back to challenge the resistance, then stocks will sell into the close. We're talking about 103.27 now. If that is kept as support and we see a move higher to the next support at 103.458 now, then we'll see a sell-off into the close. Well, guess what happened? The Dixie went down in a retest to 103.27. It was a success, and then we got a pop higher above the number, 103.458. What happened to equities? Flushing down in the last hour. We go back to the morning brief because it wasn't just the dollar. The market now has two enemies, the dollar and yields, but specifically now the longer end of the yield curve, not the shorter. So we're talking about the 10 and 30, but specifically the 30. And I said, look, notice that the inverse correlation between the 30-year yield and the NASDAQ futures provided in the chart. If the 30-year yield rallies to create a higher high today, then the Qs will make a lower low by breaking 365. Here's the chart that I gave you, the 30-year in white and then the Qs in orange. Here's the update. As you can see, the 30-year went higher, forming a higher high, and the Qs flushed down. And it lost 365, I'm going to show you in a minute. But the bottom line is, we haven't seen anything today that indicates that, okay, we're finding a bottom, we're moving higher from this point on. All what we're seeing right now is perhaps capitulation by the dip buyers and more aggressive action by the shorts, which indicates that we're getting closer and closer to a big climactic move. And then after that, we're going to find a tradable bottom. That could happen, by the way, as soon as tomorrow, midday, in the morning, depending on how we open. We'll talk about that and a lot more in the charts analysis. But since we're talking about the market, let's begin with covering the closing of the indices today. And here we go. The Dow Industrial Average closing in the red, down by 180.65 points, or a decline of 0.52%. The Nasdaq also in the red, down by 156.42 points, or a decline of 1.15%. The S&P 500 also down by 33.53 points, or a decline of 0.76%. We'll look at the sectors down across the board, and the exception is utilities, even though yields went higher. So when you see this kind of action, it tells you that we have a little bit of fear starting to creep in. The reason is utilities is a really defensive sector. So again, you look at the action today, you see the market saying no thanks to cyclicals, real estate, technology, communication services. Any of the offensive sectors were down. The defensives, utilities, and consumer defensives were leading higher. When we look at the breadth, the NYSE 25% advancing versus 73% declining. The NASDAQ 25% advancing versus 72% declining. Now, when we get to the 25s in terms of advancing, we're getting closer and closer for a rebound. We should see at least a mini rebound. But the problem is you look at other indicators and they say, no, we're going to see a rebound after these indicators here. The breadth becomes really, really bad. Maybe 10% advancing, 8% advancing, and then we get the climatic ending and the rebound. I'll talk about these indicators in a minute, but we have commodities here. The dollar went higher by about a 0.25 percentage point. Right off the gate, this is not good for metals. So we see gold, silver, copper, platinum, palladium, all down for the session. We see energy commodities now getting hit. Natural gas, crude Brent oil, WTI, all down. But interestingly, we see lumber continuing to rise higher. And you know that there is a correlation between lumber and the SPY or the Qs. And lumber was the leading indicator, which told us that we have a correction coming in the market. Now lumber says, watch out, we have a rebound coming. So we have to keep an eye here. And of course, when it comes to grains, green across the board, but wheat is down again. It lost the 600 mark. But I think the market is becoming really careless about the dangers here when it comes to wheat. Listen to this headline, for example. It reads, Russia hits Ukrainian grain depots again as a foreign ship tries out Kiev's new Black Sea corridor. So we have a lot of tensions here in the Black Sea. Something goes wrong, the tensions escalate, and then what happens? I think that the wheat market is being really careless about the danger that we're seeing in the Black Sea right now. On to the options market, aka the big casino. What do we see here? All in all, the volume is receding down. Usually it is an indicator that the retail mom and pops are not participating here. They like the action when the market is going higher, and they participate by buying calls. And now the majority of retail mom and pops say, okay, we have a downside going on. We'll wait for the dip, and then we go in and we buy these calls. And I would say you can participate both ways. You can buy puts and participate in the downside. And we have a few observations here. Number one, look at NVIDIA. The IV rank is now at almost 100%. So these options are really, really expensive right now. Why? Because a lot of folks are betting for a crash once NVIDIA reports. and others are bidding for a massive explosion higher. And we see a lot of buying out of the money in calls and puts, and these contracts are becoming really, really expensive. So this is the time when you have to be selling options in NVIDIA, especially if you happen to be a shareholder. And also if you want to bet against NVIDIA, maybe this is not the best time or the best way to buy some put options on NVDA. Maybe if NVIDIA crashes and you have a high degree of confidence that this will be the likely outcome, maybe you're better off buying a sister trade, such as buying put options on Broadcom, for example. Something to think about. Furthermore, we'll look at the put to calls ratio. Now we're starting to see more buying of puts, and this is why I say perhaps we're getting closer and closer to the climatic move. It doesn't mean that these folks are wrong for stampeding on put options. You could say that they're Johnny-come-lately, sure, but it means they could amplify the move and actually create the climax. And then we see the Johnny-come-latelys. As the percentage of puts explodes higher to the high 60s, to the 70s, then we know, okay, we got the climatic move, the VIX explodes, and now we're getting closer and closer to a rebound. I mean, you look at Apple, for example, 60% of the spread was for puts. Folks betting for more downside for Apple. It doesn't mean that they're wrong. It actually means that they could create this climatic move. Same goes for Microsoft. Almost 65% of the spread is for puts, not calls. It means that we could see maybe the last leg down and then a big rebound in Microsoft. So you got to keep an eye. You can't come to me and say, Maverick, I woke up late. These 2 days, all the way till Friday, you got to be wide awake before the market opens. Because we're going to see a lot of action. And if you miss out, all of a sudden your profits, they go kaput, poof, gone. Moving on to the unusual activities that took place in the options market today, we begin with the ticker TSLA, aka the souffle Tesla. Now, Tesla is becoming really, really oversold in many charts, many time frames. But again, if we have the climatic move, then oversold could become really oversold, an exaggerated move, a grand finale, and then we see the rebound. Perhaps somebody's betting on that because they bought the 212.5 puts for the expiration date August 25th with expectations that TSLA will go down and lose more than 6% of its value by then. Paid about $2 a piece to enter this trade, all in all, spending about $4.5 million. And then we have the ticker UNP for Union Pacific. The report was ugly, but somehow the stock popped higher. And now somebody's saying, okay, that's enough, time to go down. And they bought the 205 puts for the expiration date, October 20, with expectations that UNP will go down and lose more than 9% of its value by then. Paid about $2 a piece to enter this trade, all in all, spending about $2 million. And then on to Snowflake, SNOW. Somebody's buying a call spread here. We have the name reporting next week, and somebody sees a pop, and they bought the 160 puts, they sold the 180, all for the expiration date, August 25th, with expectations that Snowflake will move higher by more than 7% after the report, but not more than 20%. They paid about $5.20 a piece for buying the 160 calls. They received about $1.40 a piece from selling the 180 calls. All in all, the entry cost is down to $3.40 a piece, which brings the total to about $3.5 million. And then what about the trade for the ticker VXX? This is a proxy for the VIX. If the VIX goes higher, the VXX appreciates. And again, it goes hand in hand with the bet against Tesla, for example. If we see Tesla flushing down, if we see the Qs flushing down, Apple flushing down big, lots of fear in the market, the VIX pops higher, the VXX explodes higher, as this trader is betting on, then we're witnessing climax. And in this trade, the trader bought the VXX $30 calls for the expiration date, August 25th, with expectations that the name will move higher and gain more than 20% by the expiration date. They paid about 50 cents a piece to enter this trade, all in all, spending about $300,000. On to the heat map. What do we see here? Bloodbath across the board. You can see the pain in Tesla, for example. You can see AMD in chips, Intel down big. You can see technology across the board, the big caps, including Meta, Nvidia, Amazon, even the AI mania that we talked about last night, Oracle, that's down too. The Chinese names are now bleeding. Be it Alibaba, JD, Pinduoduo was up today, but they've all been weak recently. You look at the auto manufacturers, NIO, Li Auto, all down for the day. And interestingly, today with yields moving higher, the 30, you see the home builders down. So the Buffett pump is done, and we see DR Horton, Lennar down. And my hunch is the big buffet will unload these positions really soon. So if you're buying DR Horton or Lennar because Warren Buffett bought last quarter, I think it's a trade for him more than a buy. But the pain is inclusive across the board: energy, metals, real estate, industrials, healthcare, banks, all down. And keep an eye on BAC, Bank of America. Something weird is going on over there. And that's all I'm going to say about it. But you see the exceptions led by utilities. That sector is in the green, and the reason is it is defensive. And then we see some earnings plays such as TGT Target, a relief rally. We see TGX, that's for TJ Maxx, that's up for the day due to earnings. And then we have the insurance companies blasting higher because they're going to charge us more now. Tragedy is good. Then we look at the heat map for the ETFs, bloodbath across the board. Not really a bloodbath, but you can see the pain in chips, for example. You see the pain in the FXI. You see the pain in small caps. Some would argue a leading indicator. If small caps are down, we have further down to go in the SPY and the Qs. The moment you see the SPY and the Qs down, but the IWM is up, closing in the green, that could be a leading indicator that the bottom is near. And then, of course, the outperformers, as we said before, XLU, Utilities, XME. We have the steel acquisition merger mania, but that's not going to last for too long. And then, of course, the inverse indices did pretty good. The SQQs, the VIX proxies, UVXY, VXX. Besides that, it was an ugly day across the board. Now, let's do some charts and then wrap it up. We start with the SPY and hourly chart. What do we see here? We lost plenty of support, folks. We lost 443, we lost 441.69, and now we're looking for support at around 439.45. Question is it going to last or not? So let's brainstorm some bearish scenarios here. And the first one is, what if we have a big flush down in the morning, pre-market or during the session? We get the climax right off the gate, and we see the SPY flushing down, perhaps all the way to the support zone between 433 and 434. The VIX goes higher, the volume explodes higher, the readings become really oversold, and we see what? We see a buy the dip opportunity. We see the SPY closing at the highs of the day, and that would be the tradable bottom. So the bears, you got to be careful what you wish for. You might be holding short-term puts and you're waiting for a big move to the downside tomorrow. But that could mean it is the conclusion, at least for now. Bear scenario number 2 is we see a rebound from 438, for example, and then a retest to 439.45 as resistance. And maybe that is met with failure. We go down to 438. That doesn't hold the support, and we see the SPY going down all the way, the same support zone, at around 433.79 and 434.64. Well, what is the difference here? The difference is, if that takes place, the readings are not going to be really oversold. So it opens the path for more downside to come. Scenario number 3. Let's say we see a rebound right off the gate. It gets us all the way up to 441.69. Just an example. Then we see a flush down. The dollar is bought again. Gap and crap. We lose 439.45, 438. We head down all the way to the support zone. It's all about what you want. Do you want the instant gratification of a big flush down tomorrow and you close your put options? We play the rebound and see what happens? Or do you want to see more downside coming? Are you a longer term bear? If you are, you're wishing for a rebound of some sort. Fix the oversold conditions and then we go down. Because if we zoom out from the chart, we're still using an hourly chart. Look at the RSI. We're getting closer and closer to oversold readings. It doesn't mean that we can't get even more oversold. But if we do, we have a big move down. The result will probably be a rebound. So keep that in mind. We'll look at the daily chart for the E-mini futures. What do we see here? Do we have damage? The answer is yes. And the reason is we lost 4,472 as support. Do we have enough damage? The answer is no. We need to lose 4,384.5. Better yet, if we have the climatic ending, we can go all the way down to 4,300 and close the gap. And that would be the climax. And then we see what happens from there. If we have a dead cat bounce, we go down in a retest to 4,300, then we know that the job is not done. But if we get oversold readings, higher VIX, then 4,300 is a good place, at least for a rebound. We look at the SPX, the daily chart for the cash index. What do we see here? We got a retest. An attempt to recapture the 50 MA in blue didn't happen. We lost the support of 4,440.39. We got plenty of support below, but let's say we have the climax right off the gate. Can we go down to the 100 MA this time around? The answer is absolutely. And that would be coincidentally at around 4,300. And I think that's a really good place to say, okay, we got a decent correction here. Now what happens? We'll take it one step at a time, folks. We'll look at the Qs once again in hourly chart. What do we see here? We lost a lot of support. 367, 365, 364.11. And again, the bearish scenarios, number 1, we flushed down right off the gate, maybe all the way down to 357, which is an important number that we talked about before. And then we get the rebound That would be the climax, the rebound, and then see what happens. Scenario number 2, we go down to 360.42, for example. We catch a rebound, retest 364.11 as resistance, fail, go down to 360, miss that support, and we go down to 357. In this scenario, we might see further downside because the charts are not going to be really oversold. The third scenario, we get a rebound off the gate in the morning, pre-market, who knows? We get back to 364.11, maybe more, 365, it becomes a gap and crap, and then we flush down. In this scenario, it opens the path that the climax is not here, even though we're at 357 by the end. Why? Because the charts are not really oversold. The VIX is not going to pop by a lot. And we say that because if we zoom out, we use the hourly chart. The RSI is not really oversold, which opens the path once again for a climatic move, perhaps all the way down to 357 right off the gate. Then the chart becomes overbought and we see a rebound. Here's the daily chart for the continuous contract for the NASDAQ. What do we see here? The negative momentum is here. Damage has been done. We lost 15,000 of support. In a climatic move, we should go down to 14,445 and then see what happens. We look at the NDX daily chart using the Bollinger Bands, using the 20 and 50 MAs. What do we see here? We lost the 20 for good. We lost the 50 for good. We lost my support of 14,940. So again, we're looking for more downside. How far can we go? We talked about this in the weekend. How about we plug in the 100 MA this time around? Can it take us all the way down to 14,000? We call that the climax, and we finish this phase of the correction at least. Something to think about. We'll look at the IWM and hourly chart for the Russell 2000. What do we see here? The RSI is becoming oversold now. The question now becomes, can we juice a little more? Can we get it to 185, for example, get a rebound, and then we see a resumption in the selling? Maybe climax is not here yet. Maybe climax is down the road. We say that because if you look at the daily chart, the Russell 2000 is now below the 20 MA, below the 50 MA, and now we're looking at the 100 MA. You look at the RSI on the daily chart, it has plenty of room to go to the downside. So can the climactic move be a one-shot move all the way down to the 100 MA? The answer is really possible. Can that happen after a rebound from 185? Now we're connecting the dots between the hourly chart and the daily chart. But most importantly, we have to look at the Dixie, the dollar index. This is a daily chart. What do we see here? Is the dollar overbought? The answer is not quite. But we're getting there. Maybe one more pop. A climatic ending here. It gets us overbought in the Dixie, oversold in the market, and we have a tradable rebound. For now, the Dixie is facing resistance at around 103.57. If it passes, then we got 104.7. That would be a gain of about 1.25% in the Dixie, and that will produce a climatic ending in both the Dixie and equities. And what about the poor old man gold? What's going on here? As the dollar goes higher, gold becomes in a critical level now. The question now becomes, can we see a rebound from 1,893.12 in gold and we see a pullback in the Dixie? And then the Dixie rebounds and gold flushes down. That is a possibility. Can we get the climax right off the gate by gold flushing down below 18.93 and the dollar reaching the upside target? That is also a possibility. We're entertaining the possibilities here. One of them, of course, concludes the move. So again, for the bears, you got to keep that in mind. If you want the big flush down move, it could mark the end of this correction, at least phase number 1. But if you want to see it prolonged, then you better hope for a rebound in gold, rebound in equities, pull back in the dollar, fix the oversold conditions, and then resume the move to the downside. And here's the question from the viewer. It says, "Hi Mav, gold hovers around the buy point at 1928. Well, now we're below that. Do we need to see further drops in the dollar, or now is a good entry point?" The answer is not a good entry point. You gotta make sure 1,000,000% that the dollar is done moving higher. I'm not going to feel comfortable unless I see the dollar overbought, reaching the climatic move, and then reversing midday. That would be, for me, an indicator that the dollar is done with the move higher. Equities are going to rebound along with gold. Then that's a buy. But if gold rebounds right off the gate, I'll be really suspicious that this is an oversold bounce, and then we go down again. SLV silver, what do we see here? Consolidating in another bear flag leg, but is it becoming oversold? The answer is we're getting there. So again, all charts are leading to the same conclusion here. Can we see the climatic move by tomorrow or by the end of the week? Big flush down, all of these charts become oversold and they rebound and we have a tradable bottom. This is what I'm watching. and I'm watching like a hawk now. We look at Brent oil. What do we see here in the daily chart? We're moving down as we expected, so nothing new here. But we gotta keep this support. The question becomes, if the dollar shoots up higher in a climatic move, will Brent oil break this support and go down all the way to 80? If we go down back to 80, oil bulls will start to freak out a little bit. But so long as we close above 80 by the end of the week, we're good to go. We look at the 2-year yield daily chart. What do we see here? We're above 4.87, so it is bullish for now. It is looking to challenge the highs. It is gathering the energy to challenge the highs. When we talk about the climax, could it be a massive explosion in the 2-year, the 10-year, 30-year, and the market flushes down? Then we see a rebound midday or the next day. And that would mark a top in yields, at least in the short run, and a bottom in the market, at least in the short run. We look at the 10-year yield. What do we see here? Again, higher highs, higher lows. It wants to challenge the previous highs, and it beat the previous highs today. We have the highest closing in 15 years. And when we talk about the climatic move becoming an explosion and a crash instead, this is the problem here. Sure, we can see the equities market becoming oversold, the Dixie moving higher, bond yields moving higher by a little bit, and we're waiting for the climax and the rebound. What if these higher yields go way out of control and we start seeing things blow up? Then the climax becomes an explosion and there is no rebound. We got a crash in hand, ladies and gentlemen. You look at the TLT weekly chart. Once again, can we have the climatic move in the 10-year, which will be met in a climatic move in the TLT all the way down to the lows? We have the double bottom, and we see a tradable rebound. All charts, once again, leading to that conclusion. We look at the VIX. We have a higher low, gathering of energy, about to pop above 17, the resistance in a big way. And if it does, once again, it becomes overbought in the daily, the RSI, the MACD. Could we be in the process of making a climatic move? I think yes. The question now becomes, is it going to morph into a crash or stop at being a garden variety correction? We'll look at Apple, an hourly chart. What do we see here? Lost the critical support, 177.35. It had an ample opportunity to go higher if it wanted to. But investors are saying, nah, I don't like the report. The valuation is not good. So you keep knocking over and over and over and over again. At 177.35, it's going to crack, folks. And all of this is just a process to fix the oversold conditions, as you can see in the hourly chart. Now we're no longer oversold, and we have some room to create further downside. If you look at the daily chart for Apple, we use the Bollinger Bands, 20 MA and 100 moving average this time around. We closed below the 100 MA. That's a major deal, folks. And if you happen to be in the camp that says, no, this is not a garden variety correction, this is going to be a crash, the indices will go down to the 100 days moving average and then some, and Apple is the leading indicator. Then you're looking at this chart and you're saying, watch out, this is going to be big. I'm not sure that I share the same enthusiasm. Maybe I'm a little more conservative. I see a climatic move. We become oversold. Maybe we go down all the way to 171, which I see as the next support. Maybe all the way down to 165.79 and then rebound. Of course, if you happen to be in the most extreme scenario, you're looking at a one-shot move all the way down to the 200 MA this time around. That would be dramatic. That would be drastic. And it would send a major warning signal for equities. Once again, I'm conservative. I don't think I'm sharing the same enthusiasm, at least not right now. We'll look at Tesla, an hourly chart. What do we see here? It is oversold. The question is, can it become a little more oversold? The answer is yes. And if it goes down, we have 221.29. If we zoom out to the daily chart using the Bollinger Bands, 20 MA, 100 MA, you can see that the RSI is getting oversold. Can we get a little more? Can we squeeze in the climax? The answer is yes. And that would be all the way down to the 100 MA. And then we see a rebound and we take it from there. We'll look at Bitcoin. Daily chart. What do we see here? I am bullish so long as we trade above 29,200, but we lost that support today. The question now becomes, is Bitcoin anticipating a big pop in the dollar, a grand finale, and Bitcoin flushes down, then we see what happens? I think that is entirely possible. Bitcoin did not mind a brief rally in the Dixie, but if it's going to be a big, explosive move, a grand finale kind of ending, not just in the Dixie, but also in yields, then maybe Bitcoin is going to flush down, along with equities. And again, things become oversold, and we see what happens from that point on. One step at a time. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We got the initial jobless claims, we got the Philly Fed Manufacturing Index, and in Japan we have the CPI, which is going to be really important. The CPI is hotter than expectations, then the yen rallies, maybe the dollar goes down a bit, and you'd think that that's going to be good for equities here. But understand this, we got two enemies now, the Dixie and yields. And if CPI comes out hotter in Japan, indicating that the BOJ will change policy, then we could see an explosion in yields, and that could add pressure on equities. On the other hand, if CPI in Japan comes out cool, then the yen goes down. Maybe bond yields go down here, but the dollar moves higher. What would be the outcome and the reaction by equities? We can speculate, folks. We can say, okay, maybe a relief rally because yields are going down. But if the dollar goes up, how would that play out? And just by listening to that, you can now understand that the pressure is real. The market is now in a downtrend, and it's becoming stronger and stronger. And the only escape right now is becoming really oversold, hope for an oversold bounce, and then see what happens from that point. But all of a sudden, market dynamics are becoming in favor of bears for the first time since SVB. Anyhow, a lot to digest here, folks. We talked about a lot of scenarios, so digest, do your homework. But this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.